Hey everyone, on today's edition of The Final Bar, I was all queued up to talk about the second up day, nice big up move. We gave it all back in about the last 15-20 minutes, keeping the market interesting for all of us following stocks minute to minute. So a lot of interesting themes to uncover. We've got Pat Ceresna from Big Picture Trading, the Market Huddle podcast, to help us try to make sense of this market environment. Also, we're going to look particularly at a scan that could be interesting right about now. Ladies and gentlemen, this is The Final Bar. Hello, everyone. Welcome to The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining me every weekday after the close. Look at the markets from a technical perspective, connect the short term of today with the long-term trends, try to make sense of this market volatility. It's so funny. And I tell you, if you really want to have ice in your veins, attempt to do a closing bell show in this environment because things change in the last 15 to 20 minutes pretty consistently. So what started out as a pretty dramatic follow through day to yesterday, while still finishing in the positive, a lot less positive than it was about 20 minutes ago. We gave up a lot of the gains of the day going into the close. So I'll have to look at what that means for the long-term charts, how to make sense of all of this. So plenty of things to uncover. I did want to share with you some of the events and things coming up on the schedule. Today, we actually premiered earlier today on StockCharts TV our most recent special called Navigating a Bear Market. This is including myself, a number of my fellow StockCharts contributors, doing quick 5-minute hits on what we're looking at here. I'd encourage you to check it out on our YouTube channel. It's really going to be worth your time hearing from some of the great contributors that we have here. Tomorrow, we have Matt Maley joining us from Miller Tabak in the Boston area. It should be very interesting to hear his take. He actually was really helpful thinking about some of the support levels we might want to be looking at. On Monday, on our next edition of Behind the Charts, we'll feature our conversation with Jonathan Krinsky from Baker's Partners. And then also next week, we have Mark Newton from Newton Advisors, Ari Wald from Oppenheimer. So some very capable technicians. We are trying to bring in the strongest guests to help us make sense of it. Also want a couple of speaking things coming up. And the first one is this coming Saturday, the Chart Summit put on by All-Star Charts, my friend JC Peretz there. I'm going to be speaking this coming Saturday, 2 p.m. So go to chartsummit.com if you're not familiar with it and check that out. It's a free event with some really good content commentary for all of you. So let's get to the market recap today. So what we'll do is just try to recap on what happened today, try to look at some of the longer term trends and how this sort of relates to what we've been doing. So as I mentioned, the S&P was above 2550 for much of the day, which is a pretty decent gain. Following on yesterday's 9 to 10% winner, you get another 4 to 5% on top of that. This feels like it starts to feel like it has some staying power. The problem today is we gave a lot of that back up. And again, why that happened, it's always easy to figure out in the rearview mirror what could have happened, what actually happened. To be honest with you, 2 good up days after this sort of sell-off that we've been in. Anyone that sort of got in lower is pretty happy to log in that sort of gain. So certainly some flows out of stocks going into the close. The S&P finishing around 2475. That's still up 115 basis points from yesterday. The NASDAQ composite was actually down today, down almost 0.5%. Mid caps up the most, over 3%. Small caps about the same as the S&P 500 overall. So the tech-heavy NASDAQ 100 down the most. Looking at sectors, industrials, energy, real estate leading the way today. So this energy recovery theme has certainly been a part of it. Industrials as well, when you get bailout implications for airlines. If you look at a lot of the screens I was looking at to prepare for our segment, Fishing for Alpha, some of the airlines kept popping up there because they've whipped up so hard from the lows of a couple of days ago. And that's a quick turnaround, pretty decent outperformance in a couple of days. So they're up at the top there. At the bottom, we have communication services, we have consumer staples, we have technology. Now, 2 of those don't bother me too much. That's sort of fair. The fact that tech is sort of in that lower end Yesterday we had Rob Slimer from Fundstrat, and he made the comment. I asked him at the end of the interview, what would you see? He's pretty constructive, sort of saying we're at the beginning of a bottoming process. My question was, well, what would tell you that maybe that's wrong, that this is much steeper declines are going to come? And his number one comment was, or his takeaway was, if I saw the big tech names start to really underperform, start to really show some pain, things like Apple and Microsoft. So when I'm seeing the XLK in the bottom half of the list, I'm not feeling great about that. But again, always remember that let's not draw too many conclusions from the short-term movements in the markets. Here's what the daily chart of the S&P looks like. So again, it certainly feels like, overall, even with the pullback today, we were up here above 2550. We finished down here around 2475, but still up, pretty meaningfully from a couple of days ago. I mean, 2 days ago, this felt like, we're going down to 1800 in the next couple of weeks. Is sort of the trajectory we were on. Now with the congressional approval process of the bailout package, stimulus package, if you will, we've certainly seen a rally. I think what's most interesting here, and this gets to the screen we're going to look at, I was looking for stocks that have broken above that swing high, and it's interesting to see that the S&P on a closing basis has now broke above that swing high that we saw from last week. So that was after that most recent big downtrend, or a big leg down. Yeah, the reaction higher for a day or two, sort of that dead cat bounce before the plunge lower. And now we've broken back above there. So in the short term, looking tactically, we now have established a higher high of sorts. We've gone above this most recent high, which is the beginning of a bottoming process by definition. The next thing you would look for is a higher low, right? So it's all about the next leg down, which should come at some point very soon, I would expect. And it's all about where we find support. Do we find support in the 2300 level, which would remain above, or are we pushing to new lows, in which case this is just a pause within a longer term uptrend? That remains to be seen as we go through the rest of this week. In terms of other themes to pay attention to, again, with the Dow Industries, you're finding a lot of these whipping around very quickly. What's at the top of the list today are a lot of the REITs that have gotten hit kind of hard. So things like mortgage REITs, holding and development, hotel and lodging REITs, which have come out nicely from the previous lows. But you'll also see things like aerospace. This is Boeing's group, which is obviously a big beneficiary of a bailout package. Most likely, that's a local company here in Western Washington. So obviously, that's top of mind for a lot of people here, and certainly the stock rallying very nicely. Transportation services, airlines down here on the list. So a number of industrial groups that certainly have been hit pretty dramatically from all of this have recovered nicely. In terms of what's on the bottom, it's some of the other sort of recovery stories we've looked at. Things like drug retailers, which you might expect to do a little better in an extended, challenging period of social distancing and such, down over 6% today. Broadline retailers hit pretty hard. That's a group that's actually have come out pretty nicely out of the lows. Toys and others. So these are some of the groups that had sort of bounced a little bit, starting to outperform and struggling a little bit. Interesting to see internet names at the bottom of the list here as well. So this is the bottom sort of decile of industry groups. I think if there is one concern looking at these group themes, not a ton of surprises except semiconductors sort of at the bottom of the list here. And, again, this is one day, so I'm not that worried about it. But again, overall, the relative strength in semiconductors in general has tended to be a good indicator for overall market stability. And when that sector, that group starts to outperform, it tends to be pretty decent times for stocks. It's been sort of a market performer for the last 6 weeks up until the last week, in which case the relative strength sort of spiked up as it was holding up pretty well as the rest of the market going down. But a lot of other spaces sort of in recovery mode today, and semiconductors pulled back a little bit. So that's an interesting theme to sort of pay attention to as we go on. I did want to look a little bit at breadth here, just because we're not going to have as much time given some of the other segments we have today. I wanted to jump to some of these different things. The cumulative advanced decline line, we talked about this yesterday. This is now updated through yesterday's close, not through today's yet. But what I mentioned was had this negative trend in all the cumulative advanced decline lines. And until we see an uptick, until we see an improvement in the trend of those lines, I think the overall market trend is still down. Certainly an uptick yesterday, which I would assume would continue on today. But again, overall, I'm still seeing a pattern, a downtrend in most of these measures, especially in the S&P 500, sort of the largest companies that have been the most significant relative performance in terms of the breadth. So, concerning to see that, continue to stay lower. I'd still want to see that improve a little bit further than it has. A lot of these breadth measures, to be honest, I don't want to spend too much time on, only because the message hasn't changed a ton. When I'm looking at the percent of stocks above their 200-day moving average, it reminds me a lot of that early 2000, early of the 2018, 2008 to 9 period. So the late 08, not the early 09. So the initial thrust down. Same thing if we look at new highs and new lows. You have a huge number of new lows, similar to what we saw in 2008, before that next leg down that really started to be somewhat destructive. So with a lot of the breadth pictures, it's not a terrible different story than what we've seen. I just wanted to fast forward here to the bottom of the list, and we'll go on to our next segment, which is looking at two things: the U.S. versus the world. So, one chart that's interesting, the dollar strength has been a great story. That started to evolve a little bit, and you're seeing the relative performance of the U.S. versus non-U.S. really starting to come down. And again, it's still overall in a decent trend, but this is coming down a lot in the last couple of weeks. This has been going to new relative highs, suggesting the U.S. continuing to outperform, starting to come down on a relative basis. We start to break that ratio down to new lows. I think that'll tell you a little bit more about potential relative positioning and looking outside of the U.S. a little bit. The final thing was just looking at stocks versus bonds, and I think the TLT, looking at bond prices, have been top of mind for me recently. As I mentioned in the Navigating a Bear Market special, I was talking about asset allocation, looked at bonds, commodities, and currencies. To me, the ratio still favors bonds over stocks. This is this downtrend that's been happening really the last 2 months after mid-February, last month and a half. So I think that trend is still in place. In my opinion, it's still illustrating the strength of bonds versus stocks. That's our market recap for today on a volatile day where we gave back a lot of the gains. But again, I think the stories from yesterday still sort of in place. Our next segment is called Fishing for Alpha. What we love to do is use the scanning engine on StockCharts.com to reveal some opportunities. And if you're not familiar with the scanning engine, I'd encourage you to look at our YouTube channel. My boss, Chip Anderson, the founder of StockCharts, has recorded some deep dive segments. He loves the scanning engine, loves tweaking it and experimenting with different scans. So I'd encourage you to check out some of his videos. He does a great job of illustrating the power of this tool. What I want to do is just start with a quick poll. So as you probably know, on the StockCharts TV window, we always have a poll going on the right side of the screen. You'll see a little Q&A panel, and you'll see a poll. I would love for you to answer the poll anytime you see it up there, anytime you bring up the TV screen, because it's a great way to just have a good dialogue between what you guys are all seeing and what we're seeing looking at the charts on our platform. But one of the questions we asked recently: have you made any changes to your retirement portfolio since learning about the coronavirus, which for many of us has been in the last 4 to 6 weeks. I think it depends on where you're at geographically that it's become more and more real to you. But very interesting to see that 57% of you said yes, you'd made some changes to your portfolio. 43% of you had made no changes to your retirement portfolio. It's kind of an interesting one. There's an inertia that comes with investing, especially in a retirement portfolio. So in some ways, I want to congratulate the people not touching things in some way, only because, especially with a retirement portfolio, if your runway is long enough, one of the worst things you can do is try to game it in the short term and try to make, trade in and out of positions, as opposed to just parking money and letting it, the best benefit you have is starting early and letting it run. Those of you with a shorter runway, if you're getting sort of later on in your career, getting to the point where you're starting to need to withdraw some of those assets, changing them in this sort of environment, especially early on, we start to break down, can be valuable. So, again, the number one thing is to do what's right for you and your portfolio. So over half of you have made some changes to it. For me, I've always tried to use more systematic rules-based things like the long-term trend following model and the tactical trend following model I've shared with you on the show. And hopefully you have some ways to try to get on top of those movements. Getting on to fishing for alpha, the goal is to look for opportunities. So one of the scans that I've used in a correction sort of environment is the first couple lines of this. The first line is just showing I want stocks with a minimum volume requirement, only S&P names. And again, I'm using this for demonstration purposes. If you're doing it for your own portfolio, I'd encourage you to broaden that universe into a bigger list of stocks. A lot of times the best opportunities might be in names you're not familiar with, but I usually put that in there just to make sure it's names that we're all familiar with. Then two items that I added to this. The third one was a performance relative to the S&P over the last 10 days of at least 20%. So I want something that's outperformed the S&P by at least 20% in the last 2 weeks. So again, on a relative basis, not something that's up absolute 20%, but has outperformed the S&P over the last 2 weeks. So these are stocks that have come out of their lows pretty well, or at least remained in a position of strength. Then I'm going to the point and figure chart. So it's a point and figure double top breakout is positive, meaning it's recently registered a double top breakout buy signal. We're going to run that scan, which I did before the show. This is the list that comes out of it. So it's only 12 names that fit this criteria. So again, these are S&P names that have outperformed the S&P by at least 20% relative to the last 2 weeks and have had a point and figure double top breakout signal. We'll look at a couple of these names just so you can see what those actually mean. We'll start with Hasbro here. When we're looking at point and figure charts, it's a lot of times it's best to use the gallery view. What this does is it just allows us to look at a series of charts all on the same page. This is the intraday chart of Hasbro, the daily view of Hasbro, the weekly chart of Hasbro, and then we get to the point and figure chart here down at the bottom. So if you're not a point and figure aficionado, I'll give you the very quick version. And again, if you're not too familiar with this, we don't have time to really get into the weeds of it, but check out our chart school articles on point and figure. It does really well. The idea is this is not charting price over time. It's charting trends, right? So it's charting price and trends evolving from the price movement. So if it is in a column of X's, it is in an uptrend. If it's in a column of O's, it's in a downtrend. And Tom Dorsey, who I've gotten to know and have talked point and figure with a great deal, always related it to football. If you're it's easiest to score a touchdown when the offense is on the field. So you want to own stocks that are in an uptrend. So if we're in a column of X's that is broken above the previous column of X's, that means an uptrend that has gone to a new swing high. That's why this is in a buy signal pattern, because it's the most recent signal was a break above the previous column of X's. A sell signal is this, where you have a column of O's that breaks below the previous columns of O's. That tells you it's a new leg down and a downtrend. So these are stocks that have come out of those lows. What that looks like on the daily chart here, something like this. This is a stock that's come down. This is Hasbro. It's pulled up a little bit, and then it's broken above that swing high, just like we saw there with the S&P 500 today, sort of breaking above that most recent swing high. Hasbro is a name that has done that. Now, the challenge with some of the stocks on this screen is they're pretty elevated because one of the identifiers was that it's outperformed the S&P by at least 20%. So these are stocks that have been in a pretty decent place. So let's just look through them very quickly one at a time and just identify what these names are, see what sort of themes we can do. So we're going to do 10 per page, try to whip through them very quickly. So this is Hasbro that we looked at. Again, coming out of a very oversold scenario, but look at how it's performed very, very well. This is a stock that's been rallying when on a price basis, the S&P has been down pretty big. Live Nation is another one. This is within consumer discretionary, coming out of oversold conditions. But again, look how it's broken above a couple resistance levels. Not many stocks have actually done that. That's up 7% today. You're going to get some stocks that have spiked out big time from the lows. So the cruise lines are in here based on potential bailouts. Norwegian, Royal Caribbean, both fitting the list. Also Tyson. So I don't know about you, but I bought like the value pack of chicken the last time I got to the grocery store, 3 pounds, and froze some of it so we'd have it for a week or so. Tyson is ramping up production significantly, up over 5% today. EOG is one of the few energy stocks that's looked pretty decent, has not created as much as some of the others on a relative basis, actually done very, very well. Charles Schwab is doing very well coming out of the lows, and I love the relative strength that's actually going to a new swing high today. FedEx is also on the list, followed by Dow Holdings. So you have a couple materials names in here. Dow's actually come out of a pretty depressed level, but look at how the last couple of weeks have been building on a little bit of a short-term uptrend. And WestRock WRK is a similar sort of pattern as well. So they aren't the most exciting charts I've ever seen, but they're coming out of the lows in a pretty decent way. So again, the goal of Fishing for Alpha is to look for some scanning ideas. Again, that was a scan that I worked up, which was looking for names that had outperformed, but with the point and figure buy signal confirms the fact that it's broken above a recent swing high. And that's why I thought it was an interesting list of stocks to look at today. We need to take a quick commercial break. We're going to be back with my guest, Pat Ceresna. We'll see you in a minute. Hey everyone, welcome back to our show, The Final Bar. I want to thank you so much for joining us every weekday after the close to break down the technical themes in the markets. As a reminder, please keep your questions and your feedback coming to us. The Final Bar at StockCharts.com is the best way to get your questions to us. In this sort of environment, we love to help you navigate things using the charts that we have available to us. So just shoot us your questions anytime. I want to bring on my guest, Pat Ceresna. Pat's from Big Picture Trading. Also runs the Market Huddle podcast that I had a real fun time being on end of last week. Pat, thanks so much for coming on the show today.
Well, thanks for having me on, Dave.
So you sent a couple charts ahead of time, which I love. And you and I had actually talked around the interview that we did together last week about percent moves and what they mean relative to one another. So I love the first chart that you sent to us. Tell us what this means for you in this environment.
Well, you know, a lot of times as technicians, and we tend to overlay a lot of quantitative analysis, and looking at percentage change or percentage gain is always this metric that we love to kind of analyze. And to be honest, in 95% of market conditions, it actually works great because the markets are relatively stable and moving along and easy to analyze. But during a market crash, and when markets become incredibly volatile, they can be incredibly deceptive because of the magnitude of the swings. And a lot of times when, let's say, we're looking at right now sectors or stocks that are up big on a day over day or a week over week basis, they looks like there's some leadership in these big monstrous moves that are happening in the markets. And it's very deceptive because it's just a reflexive move of the magnitude of the drops. We have Boeing here, and we're just showing that Boeing was one of those stocks that came into credit risk and just nosedive from like $350 a share all the way down to $90. It was like a 75% drop to the downside. But because of the starting point of the low point at $90, even just the reflexive bounce back towards $175 on an intraday high was a 95% gain off of the low. And so the gain was greater by the numerical number, like visually, but yet it didn't even retrace half of the loss. Somebody who's owned Boeing from all the way from the top to the bottom, while it looks like there's this big 95% gain, you haven't even made half of your losses back yet.
It's such a great chart, and I love this, and I think a lot of, especially individual investors, get caught up in this trap where they're afraid to miss, like a big up day out of the lows. And what I try to remind them is remember, even with a huge up day, we're still down a lot, right? So if you miss a day, you're okay, right? I mean, let's try to pay attention to the trend. That's such a great illustration of that. Yeah. Now, you also shared a chart looking at where we're at now, and I hesitate to share your title, which is 1929 Bear Market Analog. So I would love for you to explain what this is telling you.
Well, it's not a forecast. It's not a forecast. But what it is always important to kind of reflect upon is how bear markets had a tendency to play out in the past. And it's a great way to kind of build a storyline of what could happen here in the coming weeks and months if it was to play out like bear markets have played out in the past. And so I used 1929, but to be honest, it worked actually well to use a very similar analog in 2008 after the January 2008 drop and then the bounce. What ended up happening, we're just going to talk 1929, but there was first a 45% decline in 2 months in 1929. And after the 2-month decline, that was just a devastating. It was even bigger in magnitude on a percentage basis than this drop was, a 45% top to bottom drop. But then it proceeded to make back half of the losses, a 50% retrace, in the subsequent 5 months. And a lot of people back then believed it was all over, and that was it. It was just a big crash, and it was all upside, and the market just kept going up. But then the bear market resumed. Back in 1929, it became obviously a depression. In 2008, it led to the Lehman moment and all of these other scenarios. But the point I wanted to just touch on is that a market here that puts in a short-term bottom and gets back to 2,800 should not be a surprise. In fact, that would be par for the course for following that analog. In fact, in order for the market, in my opinion, to start doing something bullish, we would need to see price action north of 2,800. If we, for the next couple of months, continuously are struggling, between 2,500, 2,700, 2,600, 2,800, and we're struggling here, then my ears are going to be perked up, looking, and my eyes will be watching, is whether or not that this is just going to roll over and some more ominous decline still may be ahead. I'm not forecasting that, but that's what I'll be watching.
It's such a great reminder, Pat. And, we spent time with Ralph Akinpor at his barn outside of Minneapolis end of last year. And what struck me when we were going around and looking at some of these historical bear market cycles was how big some of those reaction rallies were within some of the long-term downtrends. We looked at that moment exactly in the, sort of 20s to 30s. And, in any of those bear market cycles, and even after 9/11, you sort of had the rally that got a lot of people sort of sucked back in thinking that was it. So a great cautionary chart. And what I love the most, to wrap up at, is just that you've illustrated the benefits here of learning from historical charts and paying attention to what's happened in previous cycles. Pat Ceresna, right. Listen, thank you so much for joining us. Pleasure to have you on the show. I'd love to have you back again. All right.
Thanks a lot, Dave.
That's Pat Ceresna from Big Picture Trading, also runs the Market Huddle podcast, which if you haven't checked it out, do yourself a favor and do that. They do a really, really good job with that show. Certainly enjoyed it. So ladies and gentlemen, we need to wrap up our show today with the 3 and 3. So at the end of every show, 3 charts in 3 minutes. And here we go. So chart number 1 comes to me from the Final Bar mailbag, essentially. I want to thank one of our viewers for sending this in to me. He actually said, Dave, do you know how rare it's been in the last month to have 2 up days back to back? And he actually pointed out this is a similar chart to the one that he sent over to me. As of today, it felt like this might actually evaporate before I had a chance to share this chart with you, but we did in fact get a second up day in a row. And if you look back for the 2 consecutive green days, it's been all the way back here, the second week in February. Since February 11th was the last time, or February 12th was the last day we had multiple up days in a row. Since then, it's been all down days with one occasional up day that's broken. I know, while that alone does not tell me we have broken this destructive market pattern of continuous downside, I think it is worth noting this is actually relatively unusual to have the up back-to-back ups that we've had. This leads me to chart number 2, which is looking at the percent of stocks advancing and declining on the day. This is something Walter Deemer, one of my mentors, who was a technical analyst at Putnam in the 70s and 80s in Boston, have enjoyed so much getting to know him over the years, and he pays a lot of attention to breadth thrusts, 90% up days, 90% down days. So yesterday we had over 90% of the New York Stock Exchange up versus down. We had that earlier today, but by the close, it came down to about 80%, but still pretty elevated. So looking for those 90% up days, looking for when almost all the stocks are up on one day is a pretty significant thing to look for. If you look, that hasn't happened in the last year at all. Now, what you did get over the last couple weeks were a series of 90% down days, really driving home the distribution that we've had the last couple weeks in March. So if that pattern continues, if you see more days with that sort of signal, that would certainly suggest a little more of an all clear feeling than what I'm getting so far. And then the last one, boy, this is almost too much to share as one of the 3 and 3, but maybe I'll tease it here and have a chance to talk about it a little more later. One of the charts that I've looked at for years is the 2s-10 spread. So this is looking at the yield on the 10-year Treasury bond versus the 2-year Treasury note. And so the idea is you're looking at the shape of the yield curve. The higher that this is, the steeper the yield curve, meaning if you're a bank and you can borrow at the short end and lend at the long end, you're able to make money a lot more easily. You can see the last time that the yield curve was inverted was back here in 2006, 2007. This was just before, obviously, the last major market top that we had. A lot of comparisons to that period. We just got to the zero line. If you use that as your comparison, looking at 2s versus 10s, didn't quite get below, but right there. And now we're sort of seeing this reversal. So while it wasn't as extensive as we had back here in 2006, 2007, it got right to that point. The reason why I'm looking at it now is, number one, it's overbought, meaning it's gone up pretty quickly. I'd expect the ratio to come down a little bit, but if this continues higher, if you're a bank, you're in much better possibility of turning a profit in this sort of environment. Ladies and gentlemen, that's our show for today. Thanks so much for joining us every weekday after the close for the final bar. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.